All right, friends, I'm so excited that you're here with us today. I hope your Thursday has been amazing. We have a special treat for you today on Crypto Internet. Muneeb Ali, who is the CEO of Hiro and founder of Stacks, and Patrick Stanley, CEO of Freehold, have invited Dan Held to the stage to share his research on everything DeFi on Bitcoin. Muneeb, Patrick, I'm passing the mic back to you.
I feel like Dan doesn't really need an intro in the Bitcoin space, but I don't know, Patrick, if you wanna add something.
Yeah, I mean, if you want me to intro Dan, I'd just say he's probably like the best person in the crypto space, in the Bitcoin space, at explaining Bitcoin simply. I think a lot of folks approach Bitcoin just like, trying to explain it through their own lens. I think Dan does a great job of explaining very complex topics in incredibly simple ways. He also, he's got an incredible background in tech, scaling companies, and currently works at Kraken. And he's just like a one-man sort of high signal media machine. And he's a great credit to the Bitcoin space. Just like, happy to have him on today.
Thanks, guys. Appreciate the kind words. You know what we might want to touch on first before we get into kind of Bitcoin DeFi. Muneeb, you spent a lot of time in Silicon Valley as well. I wrote about this a little while ago. A lot of times Silicon Valley, they get Ethereum, but they don't get Bitcoin. What's kind of your interpretation of what's going on there? Because I'll tell my own in a minute, but I'd be really curious to hear what you think is going on there.
Yeah, that's really fascinating, actually. And let me give some context there, right? So, Bitcoin, unlike a lot of the technologies, actually doesn't come from Silicon Valley, like at all. Like in the sense that the Silicon Valley mostly missed out on Bitcoin. I think Blockstream was kind of like one of the few companies that actually raised from more traditional investors back in the day, and it's like a hardcore Bitcoin company. But most investors kind of like missed out on Bitcoin. And interestingly, there isn't a shortage of kind of like venture capital going into. I think Ethereum caught some of it, but then the next generation L1s after that, in people who raised capital in like around 2017, 2018, they definitely caught the attention of the Silicon Valley, and us included, right? Like Stacks raised capital around that time, and we were able to raise from sophisticated investors and VCs and all of that. But interestingly, going back to the model, like I think VCs are used to seeing kind of like initial version of something, or even like traditional product development. Like you have the first iteration, and then you improve on it, and then you improve on it more, and so on and so forth, right? So if somebody comes along and says that, oh, here's Bitcoin, and here's how it's broken, pick anything, right? Like, hey, it's slow, it's this, yada, yada, it's old technology, we're building the next generation, whatever, right? That actually fits perfectly in a traditional VC mindset, right? And interestingly, like that I have found in my last, 8 years in crypto, to be a fascinating thing, that Bitcoin doesn't work that way. Like in the sense that whenever someone tries to improve on the original design of Bitcoin, you after like a lot of time and effort, actually realize that by trying to improve that one thing, you've actually made something else worse, like worse than before, right? And it's like mind-boggling. That's why I sometimes joke that Satoshi was a time traveler, right? Like it's kind of like a half joke. What I'm trying to refer to is, how can someone design something where you're optimized so many complex design trade-offs to an extent that whenever someone comes and tries to change the balance of it, they actually make it worse, right? And I think that is the thing that is very counterintuitive to traditional VC investing.
Yeah, let me piggyback off of that. So I've been a product guy. I've been in product and marketing, and I don't think it's ever occurred in Silicon Valley where like the first product that was shipped is the product that you see today. Like we don't use the original version of Facebook. We use version like 1000 of Facebook. It's this constant iteration and tweaking and refining and pivoting, and it's perpetual, right? Like even very mature products like Instagram had to pivot to thwart Snapchat from coming in and taking over with, and they used Twitter. They used what's it called? It's the stories. They use stories for that. So Instagram thwarted Snapchat from coming into their territory by building stories, which was an equivalent feature. So even mature tech companies have to keep iterating. What we're talking about right now, Spaces, is a pivot of Twitter to take on and thwart Clubhouse from taking over some of their business. So the idea that Bitcoin got it perfect day one is just so impossible for them to even consider. They're like, there's just no way. They think about it like code. They don't think about it from the human mindset of like, no, this is money. It's not necessarily code. Code is what makes the money, but really it's a belief system of people believing in this code and storing value in that code. So yeah, I think that was a really interesting part for me to see with Silicon Valley. It's just like, it's this constant iterative place, and Bitcoin, and when Bitcoiners say we don't need to change, VCs and Silicon Valley people immediately go, that's a narrative violation. There's no way that's possible. And so I'm going to look for the next best thing. I'm going to look for something that changes all the time. But when we look at Bitcoin and we see this very slow changing, extremely slow changing base layer, this is a good thing. You want to build the financial system on a solid foundation. And I believe, Muneeb, that's why you guys have looked over the years on how to build on top of Bitcoin. That's part of the reason why you want to build on Bitcoin, is because it's that solid foundation, right?
Yep. And I think, let me give a little bit more historical context there. This idea of kind of like enabling other applications around Bitcoin actually goes back all the way to like 2010. There are Satoshi discussions on Bitcoin talk where they're talking about kind of like, how do you reuse the compute power of Bitcoin and enable these other use cases. Specifically, they were talking about BitDNS, which evolved into Namecoin, and Namecoin was kind of like being merged with Bitcoin. And interestingly, even if you think about Satoshi's thinking back then, Satoshi's thinking about how do you align incentives at the base layer by reusing Bitcoin's compute power, right? Because if you don't do that, if you go off and you kind of like start your own tribe and you're using your own resources, now you have competition at the base layer. And these systems, they're going to keep fighting with each other because they're not in equilibrium, right? But if you agree on the base layer, you're like, hey, I agree that Bitcoin is the most secure base layer. Bitcoin is going to be the reserve currency. Then I'm economically aligned with Bitcoin, and I'm actually trying to do things that benefit Bitcoin, and because I'm dependent on Bitcoin. And that was like a pretty hard, from a technical perspective, challenge. And the options in front of us were kind of like, hey, should we go off and build a separate blockchain? Or should we try to kind of like build on top of Bitcoin? And interestingly, this is also counterintuitive. Starting a new blockchain is technically the easier thing to do because you actually control more of the blockchain, right? Like you control the design, you control the code base, you just go off and build it, right? Trying to work with Bitcoin, because Bitcoin is not going to change, is the harder thing. And time again, we basically, if you have a very long time horizon in mind, I would just play the story in my head that, let's start a different blockchain. It's going to get some traction. It's going to happen. It's going to happen. But eventually, whenever the time horizon becomes like 10 years or 15 years, I'd be like, if Bitcoin has just taken off as money, as the global settlement there, and as a kind of like, this almost like a ubiquitous thing in the world, my blockchain is not going to be able to compete with this, right? So whatever it takes from a technical perspective, we have to crack that to enable these applications around Bitcoin. versus trying to go off and start something new. And I think the jury is still out there. That was that the right call or not? Like I'm talking about 2013, 2014. This is like pre-Ethereum. Like I saw Ethereum white paper emerge in front of me, right? And you could argue that starting a separate blockchain or something could have been the right decision. But I would say the jury is still out there. We still don't know what's the right cause, and I think we still stand behind that building of Bitcoin is going to be the right decision long term.
Yeah, I think a little bit more historical context. I think people look at Ethereum and they're like, this was inevitable. But at the time, when you were considering building stacks, and I remember that era too. I mean, back from the 13, 14 era, there was a lot of competing layer one blockchains. Like for example, there's one called Counterparty. And can you, it's a little too technical for me to talk about. Do you remember Counterparty, Muneeb? And did you consider that to build on top of that?
Yeah, so Counterparty was interestingly literally on top of Bitcoin, right? Like that was one of the ones that was on top of Bitcoin, but there were all sorts of other things that weren't. And interestingly, in the last 10 plus year history of crypto, there's only one constant, like it's Bitcoin, right? Like if you look at the top 10 blockchains over, call it 4 or 5 year period, they come and go. Like Namecoin used to be the number 2 blockchain, right? And now Namecoin is effectively dead. Like I think it basically had a market cap of like 4 million or less than that. These things like shuffle and they come and go, and Bitcoin has been that constant thing throughout. A lot of the ideas, even like you mentioned Counterparty. Let me make a quick comment about that. A lot of the ideas about even doing token offerings or creating new types of tokens, right? Which was the big use case of Ethereum in 2017. Or even NFTs like rare pepes, or even ideas of like these atomic swaps, or a lot of that actually can be traced back again to the original Bitcoin community, Counterparty, and these things happening about Bitcoin. And these ideas have transferred over, and obviously now the time is better for some of those ideas, and they're finding more traction in these other ecosystems. And somehow like people have forgotten that these apps and smart contracts can actually exist in the Bitcoin ecosystem. They're a little bit harder, but you can crack those problems, and all these use cases just live in the broader Bitcoin ecosystem instead of living somewhere else.
Yeah, people forget that on Counterparty, those were the first NFTs of the rare pepes. That was 5 years ago, 6 years ago. That was a super long time ago. It's a combination of like right tools, right network effect, right time. And people also forget Lightning. Lightning is a smart contract. There's a lot of narratives and rebranding of what things are, and sometimes people don't port that branding from the Ethereum side over to Bitcoin, where they're like, "Oh, Bitcoin is not smart contracts." I'm like, well, what is multisig? What is Lightning? What are DLCs? These are like very immediate, very apparent, very talked about. DeFi on Bitcoin or smart contracts on Bitcoin, and same with like what Stacks is working on. So I find it just kind of Ethereum sort of captured this entire narrative, and I think when people objectively look at it, you're like, oh, well, Bitcoin can actually do some really interesting stuff.
Yep, I do think like the Ethereum community deserves credit for marketing, and let me actually give you. You mentioned Lightning. Let me give you a great example. So back in 2016 or so, when research on ETH2 was starting, I was pretty vocal about adding more complexity to the blockchain with these crazy sharding ideas and whatnot is likely not going to work. L2s are actually a much better scalability solution, right? There's like public documentation of these things. And L2s like Lightning, I was like, hey, that's the way to do scalability. Fast forward like 5 years down the road, like imagine the kind of like marketing, almost like genius that it takes, that Ethereum has actually taken a full U-turn. They have slowly kind of like, dropped the shards and ETH2, like there aren't even smart contracts on the shards anymore, right? And then the latest situation is just like data. And they are celebrating the summer of L2s. They've actually completely owned the idea of like L2s for scalability is kind of like, our thing. And this is how we're gonna scale. And you scratch your head a little bit, like, isn't this what the Bitcoin community was saying like in 2016? And we didn't even like, go down the path of trying something crazy as sharding, because a lot of like really smart engineers could just see that that's not gonna work. But if you look at the narrative out there, nobody would give credit to the Bitcoin community for figuring out the right scalability solutions as L2, right? Like it's all about L2s are going to scale on Ethereum now.
Yeah, and even during the scaling debates, Vitalik sided with the big blockers. Remember the congratulations on the seriously comment?
Yep. That's true.
Which was, I found that to be very bizarre, because as we all can see, scaling is the logical way to, using different layers is how blockchain should scale. So yeah, they definitely, I think the Ethereum community in terms of marketing is phenomenal. And Vitalik is a genius marketer, absolutely genius. And they're able to craft narratives and memes, and Bitcoiners, I think, are a bit slower or don't really see this sort of narrative back and forth, and they just go, oh, Bitcoin's Bitcoin. But it's more about, I think about it more of like, let's tell the story of Bitcoin, of Bitcoin's origin story, and Gold 2.0. And it's not just a dumb rock, though. It can do these other things as well.
But arguably, Bitcoin has, to Bitcoin's credit, not to anthropomorphize it, but to Bitcoin's credit, it has essentially become the category winner for internet money, right? And the idea, like, just bring this back to the sort of title topic, the idea of Bitcoin, a DeFi really taking off on top of Bitcoin, which is the category winner of internet money. What then happens to other DeFi projects that aren't on Bitcoin? Does it just result in balkanization or a competition for a settlement on layer one, like most settlement on layer one, insofar as DeFi is concerned?
I can chime in on that a little bit, right? So I think if you think through the idea of like decentralized finance, again, like these ideas are not new. Like they're deeply rooted in even the early cypherpunk community, right? Like if you're thinking about decentralized exchanges, like they weren't invented like 3 years ago. Like people have been talking about this type of trade and exchanges, privacy, and all of the decentralized finance stuff. Like even before the internet revolution, like I'm talking about the 80s, late 80s, early 90s, and a lot of people who have like thought very deeply about these primitives basically come down to the concept of sound money. Like you first need that layer. Like that's the layer that is going to enable everything else. Right? And interestingly, so I don't want to make this like more of a Bitcoin versus Ethereum thing, but these are the two largest ecosystems, and you have to like kind of like address what's going on practically in the industry right now, because Ethereum was always more experimental, and in some ways, in my view, like to the extent of being reckless. But if you are more experimental, you get to try out a lot more things, right? And I think that has actually been, in some ways, like I said, double-edged sword, right? Like obviously there can be a lot more hacks. It's like you're breaking things, but you're also experimenting a lot more, and you're trying out a lot more, right? So there have been a bunch of experiments, and they have built out these like almost like Lego blocks for decentralized finance. But interestingly, this is very similar to the L2 scalability type of. After trying those things out, they've come around to some sort of a realization that you can't have decentralized finance without sound money, right? And that's the latest kind of like narrative shift that's happening. That earlier, Ethereum was fine being kind of like gas for smart contracts. It's like maybe we don't even compete with Bitcoin, right? Like we're just gas for smart contracts. But now Ethereum is trying to be ultra sound money. Right? And the reason for that is actually very deeply rooted, because you need to have that sound money base layer to have a thriving, sustainable, like long-term sustainable DeFi ecosystem around it. If you don't have the sound money base there, it's not going to be sustainable over the long term, right? So that's the realization again, and I think in some ways, like it's very smart as well to now try and almost like pivot Ethereum, the asset, from a gas asset to a sound money asset. But obviously, you know, it comes with a lot of problems because this is not what it was designed to be in the beginning, right? So they have to dance around and change things and then try to make it something that it wasn't originally.
Yeah, and I think maybe this is a good time because I agree with Muneeb. I'm not sure if we want to turn this into an Ethereum versus Bitcoin debate. You know, I think we've kind of all spoken our piece on that. But yeah, for me, it's been like a super interesting experience digging in on these various protocols. And you know, next month, what's coming out for me is around SOV, and the RSK blockchain. So, you know, as I've been exploring these, you've got, you know, the Bitcoin community, I think, you know, we said, hey, look, we want the base layer to be very slow changing. We don't want to introduce a lot of openness to change different things on layer one. So we push innovation on layer two. And so there's different ways to do this. There's pushing innovation on layer two, which is like Lightning and DLCs. And then there's also like merged mind RSK, and then there's stacks. So I can give my explanation, but Muneeb, I want to give you first chance at it, at kind of explaining the difference between stacks and those other options.
Yes. So I think in general, the core problem that people are trying to get at is the same, that they accept Bitcoin as sound money, as a stable base layer, and they're trying to enable applications around it. And ideally applications where you could almost like take Bitcoin from the base layer, move it into this blockchain on the side, like, you know, that's where the term sidechain comes from, and move it back. And the applications are kind of like contained in a different layer, or maybe in a layer two, and so on. So there have been like various kind of like technical attempts at it. Merge mining is this concept where you're trying to convince the Bitcoin miners who are doing these calculations anyway to then reuse the same hashes to secure another blockchain, right? So the earliest version of that was, again, going all the way back to Satoshi. Satoshi actually contributed these ideas to Namecoin. Namecoin was the first merge mine chain, and RSK is kind of like the latest version of that. Right, and there are some fundamental limitations there because you have to convince a lot of the Bitcoin miners to care about the merge mine chain, and historically that has been problematic. Huge kudos to the RSK team that they've actually been able to convince a significant amount of Bitcoin miners to also mine the RSK chain, and that gets it to a certain level of security. Right, then you could say that, hey, maybe I don't want to kind of like run this separate blockchain, and I can get into like what are the benefits of doing that. Maybe I am okay with more constraints on me, and I can just try to use Bitcoin directly, right? So some of the approaches where, because Bitcoin has a scripting language, right? So you try to use Bitcoin script, or you can try to extend Bitcoin script, but directly on the Bitcoin blockchain, right? And that's generally hard. And some of the approaches like DLCs, they're kind of like saying that, hey, we will do some computations offline, and then we will use existing Bitcoin script to do part of the things on the Bitcoin chain, right? So it's a trade-off. Like the way I think about it, it's a trade-off between complexity and not changing Bitcoin, right? So they have some offline complexity. And then they don't need a blockchain. But what Stacks went for was that, we will actually give you a fully featured smart contract platform, like similar to Ethereum, So it's fully featured, like, nothing is offline. It's not very complex. You can basically do whatever you want to do. And the trade-off that we made over there is that instead of doing merge mining, we could have done merge mining, but I don't want to get into details, but I've actually worked on problems with merge mining, discovered bugs on Namecoin back in the days, and so on. Like from a game theory perspective, merge mining is somewhat problematic. And we effectively made the trade-off of introducing a separate gas asset, like what Ethereum was originally supposed to be, like a gas for smart contract asset. So Stacks is not trying to be sound money. Stacks is actually fully dependent on Bitcoin for existence. It's almost like a additional kind of like layer that has consensus across Bitcoin and Stacks. And I'll pause there and stop there because that, I can answer any other detail if you're interested.
And I think kind of my TLDR of when I explore these different DeFi solutions, and I'm still pretty early in my journey, is that there's always a trade-off. You're never going to have on the Bitcoin blockchain settlement assurances. Now, Stacks is interesting because part of the leg of a smart contract on Stacks could have the settlement assurances of a Bitcoin transaction, which is kind of interesting. But as you move up these layers, or as you introduce like merge mined sidechains, there's different risks, there's different rewards that are introduced. I think that was kind of like, it's such a fuzzy gray area where I think a lot of people think about it from like a binary standpoint, and it's more of like there's a lot of interesting concepts, and each one comes with its own trade-offs.
Yeah, I think that's exactly right. That there's no let's compare approaches like DLC. I think they sound really nice, especially from a like if you're a Bitcoin purist and you're like, hey, the only asset that should exist in the world is Bitcoin, and don't introduce any other gas asset and so on. It achieves that purpose. But the question to then ask is, what's the trade-off? Like, what's the trick? How are you achieving it? And the trick is that the contracts actually become very complex. To write a contract, you actually have to have offline communication with the party that you're trying to have a contract with. Like in certain cases, like that's a huge limitation. Like the entire DeFi space is taking off because these Lego blocks are just online, and any developer in the world or any contract in the world can just interact with any other contract. And I think that's like a superpower. So if you require to talk to a party offline, even before starting a contract, like that, I would consider that a huge limitation, right? And then you actually have to do computations on possible outcomes of the contract and sign them. And it's a bunch of data, and then you try to like compress that data and broadcast some amount of data on the Bitcoin blockchain, right? So your footprint on the Bitcoin blockchain is actually larger, and there's significant kind of like computation required for computing all the possible outcomes of the contract versus on the more modern smart contract languages, like the ones that exist on Ethereum or on Stacks. Like you don't have the problem because you don't have to compute every possible outcome of the contract. When the contract runs, everyone knows what the contract did, right? And so but the trade-off there is, and obviously this is a huge issue in the Bitcoin community, because for these types of smart contracts, you do need a gas token, like, because that's kind of like how these things work, and you have to incentivize people to run these contracts and so on because they have globally shared state. And I think that sometimes becomes a tricky topic, right? And I've spent enough time in the Bitcoin community that there was one very clever hack that we did, that we knew that we would need this gas asset Stacks to run on the Stack side, but we actually enabled people to pay the gas fee in Bitcoin on the Bitcoin side, right? So whenever somebody says like, hey, why do you have this gas token? My response is, oh, great. For a subset of the functionality, you can actually just directly use Bitcoin as gas if you want, right? It will be a lot more expensive. You probably don't want to do that, but you can. It's an option. And it's amazing how people's reactions just change as soon as they hear that, oh, I can actually use Bitcoin as gas, right? And that's great. Now this is fine.
See, I lost my connection there for a second. What was the last word you said there?
Oh, I was just talking about the feature where people can pay gas fees in Bitcoin for a subset of transactions.
Yeah, I think the audience would probably be curious how that works. Now, I've seen a smart. I'll walk through kind of like a hypothetical smart contract that you guys mentioned that I looked into a little bit. So let's say you've got USDC or some sort of stable coin on the Stacks blockchain. Now you can set up something where you could borrow Bitcoin using that USDC as collateral. Since the Stacks blockchain looks at the Bitcoin blockchain, on the Bitcoin blockchain, if you want to borrow Bitcoin on the Bitcoin blockchain, you could receive Bitcoin in a Bitcoin transaction on the Bitcoin blockchain from the lender to the borrower, and the Stacks blockchain could monitor the Bitcoin blockchain to make sure that you were paying back the loan in the form of like interest payments on the Bitcoin blockchain. And if one of those payments weren't received or wasn't received, you could decrement the USD balance in that stablecoin collateral on the Stacks blockchain. And I'm assuming pricing data would be piped in via an oracle. And if Bitcoin's price dipped below a certain value, the stablecoin asset would be liquidated. So Muneeb, could you walk me through a little bit more of how something like that would function, or maybe how the Bitcoin interest is could be paid on the Bitcoin chain? And then when you talk about gas, I know gas is different than what we just described, but can you kind of walk through like this, the Stacks blockchain when it looks at the Bitcoin blockchain, if the gas fee has been, how does that gas fee get paid? I think that's kind of the part I missed out on.
Yep, happy to get into it. So I think the way to think about Stacks is that it's really kind of like a hybrid system. It's like a cross-chain type of system, right? In certain ways, it acts like a L1, like Ethereum, that is just separate and has its own security budget. But in some ways, like it has very deep connections with Bitcoin, right? So you could do some cross-chain communication very natively. So that's the first thing to keep in mind. Like just imagine there's some sort of a hybrid. Even our consensus mechanism was designed as it has hybrid properties from like proof of work and proof of stake. And I don't want to derail into recycled proof of work, but it's a pretty fascinating topic. So keeping that in mind, that Stacks is kind of like this hybrid thing that is connected to Bitcoin, and you can do some cross-chain stuff there. The way to design this application is that your Bitcoin that you want to lend out always remains on the Bitcoin chain. So there are no wrapped assets involved. Like you don't have to go through custodians. You don't have to pay taxes or KYC in trying to kind of like use a lending application. So your Bitcoin always stays on the Bitcoin chain. It is always secured by Bitcoin's main network and by your keys, right? But the smart contract logic lives on the Stacks side, and the Stacks chain, like any other smart contract platform, can have all sorts of assets on it, right? Like stable coins or derivatives or NFTs, whatever you might have. So in this case, like let's say you have a stable coin and you want to, let's say Goldman Sachs comes in and they can't hold Bitcoin on their balance sheet, but they want to trade it, right? But they have USD capital. They get USDC, and I think USDC actually announced that they're launching on Stacks. So let's say it's a very compliant type of a stable coin like USDC, and Goldman Sachs says, "Here's my collateral, and I want to borrow like 100 Bitcoin or something, and I'm willing to put up like 150% or 200% in collateral." So the Stacks side, because these new assets can only be defined on the Stacks side, they can't be defined on Bitcoin anyway. So it's completely natural for USDC to live on the Stacks side, right? And the USDC gets loaded up in in a smart contract. And now the Bitcoiner who really cares about Bitcoin and doesn't want to lose their Bitcoin, they're basically trusting that smart contract logic, right? So that's like one level of risk you're taking. And that's where we were very careful about designing this programming language. It's called Clarity, and it's decidable, meaning that you can have mathematical proofs for what a contract cannot do. So now you're actually like not trusting a smart contract. You're actually trusting mathematics, which is a much better position to be in, because there could be mathematical proofs that if your Bitcoin doesn't come back when you were lending it, you will get that collateral, and then you can go and buy more Bitcoin. So the way to use this app would be, you would look at the smart contract. You'll know that this is the collateral that is being offered. This is the interest that is being offered, and I need to send my Bitcoin to this address to kind of like trigger it. And because Stacks can watch everything that's happening on Bitcoin, Stacks, the smart contracts on Stacks, they can react and be triggered by Bitcoin transactions. So as soon as you lend the money, let's say Dan was lending to Goldman Sachs, right? So he sent the transaction, the loan would trigger, and time is calculated in Bitcoin blocks. Like everything on Stacks, the source of truth is always Bitcoin. Right? So Bitcoin blocks are the sense of time here. That's what the loan was for, 150 blocks or roughly a day or something. And if Goldman Sachs gives back the Bitcoin, they would give back the Bitcoin, and then they would have to give back some interest. And I think it would depend on the design of the smart contract. Maybe the interest is in USDC, or the interest has to be in Bitcoin. So then the contract is monitoring that you'll get your principal back, but also the interest on top. And if they return the right amount, then the contract knows that they fulfilled their obligations, and now they can get the collateral. Right? So this is how an application like this would work, which is super interesting. And a related thing to that is a functionality that went live recently, and a bunch of developers, some of them I actually see in the audience, they were having a field day with it, is that they were actually swapping new types of assets on the Stack side with Bitcoin, but the Bitcoin transactions we're having on the Bitcoin side. Okay, so think of that as this is like native Bitcoin swaps. So anything you want to buy with Bitcoin, let's say it's an NFT or something else, like it's a similar type of a contract. And your transaction is a Bitcoin transaction, pure Bitcoin transaction on the Bitcoin side, but the smart contract that was selling you the NFT or that was selling you a derivative or some sort of other financial product can actually react to it. So you swapped out your Bitcoin with something else by doing a pure Bitcoin transaction. And we thought like that was super fascinating.
Yeah, and then that was really cool. What I found interesting about Stacks too is the kind of recycling of proof of work, where it's a proof of burn mechanism that you all took, and instead of burning the Bitcoin, so that's how it's kind of recycled in a way, is that you're taking the existing proof of work that's generated Bitcoin. Stacks miners earn money in Bitcoin fees, but the proof of burn mechanism, normally the miners would just burn Bitcoin. They would send it to like an unspendable output. But you guys decided to take that and instead reward the Stacks holders. So I thought that was a novel incentivization mechanism. How did you guys go from kind of that thought process on proof of burn to like proof of burn, but using the burn instead of burning it, using it as an incentive? And will it ever go to just pure proof of burn, where Bitcoin could kind of become deflationary, where more and more Bitcoin would be intentionally sent to an unspendable output because it's being used as a proof of burn mechanism on the Stacks blockchain?
Yeah, so I think it actually goes back to the same fundamental problem I was talking about earlier, that can you enable other applications around the same blockchain like Bitcoin, or do you have to start different blockchains for different applications, right? So merge mining was kind of like, hey, people are calculating these hashes, they're burning electricity and they're calculating these hashes. Can we try to reuse the hashes? Right? And that's really where merge mining comes from, that they try to reuse the hashes to secure additional functionality. This is proof of burn is very interesting because the other thing that is there other than the hashes is actually the Bitcoin itself. Right? So the Bitcoin actually represents the calculations that happen for the hashes. So we were like, hey, why instead of trying to reuse the hashes, why don't we try to reuse Bitcoin itself? And I think it changes your mental model of how you think about Bitcoin, because Bitcoin is Bitcoin in a way has stored a certain amount of energy in a digital format, right? Because it is proof that someone has spent a certain amount of electricity, and I think that's very powerful. That's what makes a Bitcoin scarce in the digital world. So you can take the Bitcoin and try to reuse it by securing another blockchain. So that blockchain is actually not going over the process of burning electricity and creating a proof of work token, because you're just burning the proof of work token, and they're actually equivalent. Like you think about it, it's the same thing that I burned electricity and then created a Bitcoin and then destroyed it. It's the same thing as destroying that electricity that was originally consumed, right? So even from a security perspective, like it turns out to be the same thing, right? So that was the original idea, and then the improvement on that was pretty cool. And Patrick here is actually a co-author on that paper with me and a bunch of others. It was this feeling that, a lot of people that we would talk to this idea about, they would be like, man, but you're burning Bitcoin, like Bitcoin is so valuable, like it just feels bad. And we will try to explain that, hey, this makes Bitcoin for everybody else more valuable. When the supply of Bitcoin is going down, here are the reasons. But at a gut level, a lot of people would have like a bad reaction. They're like, hey, I wish you weren't like destroying Bitcoin. Like, I can see that. Like people love Bitcoin. Like they don't want to see it being destroyed. And I think that was the genesis of like, can we try to reuse that? And that led to like this recycling mechanism, right? Where the security properties are still the same, right? So instead of these miners destroying Bitcoin, you have to come up with some sort of a reward set. That here are the people who can receive this Bitcoin instead. And then interestingly, the analogy in the Bitcoin world would be that instead of electricity being burned, electricity is being sent to Bitcoin holders. Like electricity just appears in your home, right? If you own Bitcoin, like that's the analogy there. But it is being spent by the miner, right? So the security budget is there. So that's the kind of like the genesis of it. And then it became super interesting. And this is honestly, we didn't even fully realize how powerful the concept was, because we didn't realize that the fact that people are now earning Bitcoin makes Stacks a unique type of an asset, because Stacks is the only asset, a crypto asset out there where people can actually earn Bitcoin on it, right? And the earnings are actually quite significant. Like right now, it's around 10%, and this ratio will likely stay there for like 4 years, and we have the Bitcoin halves, right? So when Bitcoin halves, Stacks issuance also halves with it. But the Stacks issuance doesn't go to zero. When Bitcoin issuance goes to zero, Stacks issuance doesn't go to zero. It's a separate topic. We can get into like why that is. But interestingly, now people are earning Bitcoin, and programmers are treating Stacks as almost like a Bitcoin yielding asset, almost like a Bitcoin bond, right? And they're already playing around with different types of financial instruments that they can construct when they have a Bitcoin yielding asset. And I think that was like completely something that we didn't even realize. Like we thought that was a nice feature, but we didn't realize that it would become like such a primary attraction for a lot of developers, because they will start doing like interesting type of like financial engineering with a Bitcoin yielding asset.
Yeah, as I like to say, the Bitcoin yielding asset of Stacks is like butter, just makes everything better. And we're seeing that. Newsweek just published an article about Miami Coin, in where Francis Suarez, the mayor of Miami, was essentially promoting the launch of Miami Coin, which project I'm involved in, that uses stacks yet again for proof of transfer for Miami Coin. So you have a dual yielding asset in Miami Coin, where it yields both stacks and then subsequently Bitcoin as a function of stacking both. So it's kind of cool, yeah. Definitely kind of like view stacks as it's almost like a Bitcoin bond, where it becomes more valuable, and the subsequent assets that are built on top of it become more valuable as a function of their use. It's almost like you're kind of like terraforming Bitcoin with new ideas. The proof of transfer concept is a really sort of good mechanism for measuring how well you're doing that. Muneeb, Dan, unfortunately, I know you guys are doing a lot of the heavy lifting here in the conversation. I unfortunately have a hard stop, so I got to hop out, but it's great listening to you guys. Hope you can continue.
Sure, Patrick, and I know that there's a lot going on with the mayor of Miami and whatnot, so I'll let you go. Yeah, I wanted to add this thing about gas assets. Like originally, our motivation was to just separate out store of value from gas for smart contracts, and we talked about how you can have some sort of smart contract without having a gas asset. Like DLCs come to mind, but it's actually a complexity trade-off. Like you end up with a much more complex, or in some ways limited, type of a smart contract language. But if you do have a gas asset, you can actually have a global state, and any contract can interact with any contract, and it just becomes a lot easier for developers to program these things. But we never fully realized that the second function of a gas asset, where there's a Bitcoin yield attached to it, could actually be so powerful, right? Because this is the thing that is attracting a lot of people. Like what Patrick was describing is also, these were conversations about trying to convince Miami that, hey, can you put Bitcoin on your balance sheet? And one thing led to another, and it's like, hey, what if there's some sort of a governance type of a token for a city, and if a city is making bad policies, there's a public ticker, right? Imagine Miami versus San Francisco, and if San Francisco is making really bad local government decisions, you're kind of punishing, the markets are punishing San Francisco by shorting that asset again, versus if the Miami mayor is making all the right decisions and attracting a lot of tech talent or whatnot, or is crypto friendly, the markets are responding that way. We've seen this with people betting on Trump futures or something like that on FTX. But then there was an interesting play that if you create this asset in a way that you attach stacks with it, because stacks is a Bitcoin yielding asset, then it suddenly becomes more meaningful. It's not just a futures type of a thing that people are just shorting or having fun with. It is an asset that yields Bitcoin, and it is at least as valuable as the Bitcoin yield that is given, right? And that led to things like, hey, what if the city of Miami has a treasury that gives out a Bitcoin yield? Even if it's I don't know, a couple of $1 million or something like that, that could be very interesting for them to actually earn Bitcoin and then try to do some interesting things with it, right? And obviously, I'm not directly that involved with the project, but I find it very, very intellectually interesting.
We have quite a few questions coming in. Okay to take them? Okay on time?
Yep.
Great.
Yeah, I've got 10 more minutes left.
Great, thanks, Dan. Jeremy, go ahead with your question.
I don't really have a question. I just do a lot of work on DeFi Bitcoin. Figured I could be of use if anyone wants me here.
Thanks, Jeremy.
Yeah, that'd be awesome.
Hey, Jeremy.
All right, cool.
Hey,
We have Thomas McCarthy. Go ahead with your question when you're connected.
Thanks so much. Yeah, so my question is with the wallet. I'm wondering if Stacks or Hiro ever has an idea of being able to stack with more than just one validator.
Sure. So I think there are a bunch of different wallets available. One is from Hiro, that's my company. I think I see Dan in there as well. He has Boom Wallet. There's Xforce and a bunch of other these things. And at the protocol level, what's happening is that you're kind of like locking up stacks in the consensus mechanism to earn the Bitcoin yield, right? So, and it's like one address gets one Bitcoin address. So you specify the Bitcoin address where the yield should go on the stack side, and this is where the cross-chain stuff comes in, and then the miners know where to send the Bitcoin. So the limitation there is that whatever 1-to-1 ratio you're telling the smart contract that this stack address is associated with this Bitcoin address. So you would, if you have some additional stacks like on some other wallet, you would have to come up with that mapping. You could even map to the same Bitcoin address as well. So let's say you have address 1 and address 2, and both are pointing to the same Bitcoin address. That's possible, but you can't lock additional amount on the same address. Right? Let's say you're locking 100 stacks, you can't now lock an additional 200 on top or something. It's a current limitation. I think there are some improvement proposals that might improve this down the road.
Okay, yeah, thank you for explaining. Yeah, I wasn't aware of this, so I like locked up part of my STX for like a really long time, and I only learned about it afterwards. So I'm in the waiting, but yeah, now this makes a lot of sense. It sounds like it's difficult, but that would be hugely helpful instead of just being like, because I'm limited with only being able to stack with one, and I like being able to support multiple different validators. But again, I appreciate you explaining, and so I'm definitely gonna be more careful. And thanks so much. I really support this project, and I think it's gonna be great for the entire Bitcoin ecosystem.
Awesome. Thank you so much.
Thanks, Thomas. Any other questions?
That's it for me. I'll let someone else ask as well.
I think Dan did a very interesting deep dive on Bitcoin DeFi. Like I highly encourage people to go and read it. You can go to Dan's Twitter and I think just scroll through and try to find it. Like that was, I think what I like about that is like Dan is kind of like like a example Bitcoiner, right? And he's taking a deep dive into various projects with a fresh eye, right? And that is very different from someone like me who's been like in the weeds of trying to build these things. So the perspective that he brings, and obviously he compares across like different projects as well, is actually what a lot of people would find useful versus kind of like the more deep, kind of like in the weeds technical stuff that I usually stuck in.
I appreciate that. It's, for me, it was a journey of good exploration and discovery. I felt like I wasn't able to really adequately explain certain DeFi concepts, and I hadn't dug in as deep as I should have. So this has been like really fun for me to dig on various projects.
Awesome. We had a few other questions, but then they dropped through. Here we go. Dan Trevino, do you have a question? Go ahead, Dan.
Sorry, I was talking without the mic. Yeah, I have a question for Jeremy, actually. I had attended the Miami PlayFi and really interested in what Sapo is becoming. And I was just wondering if you've had a chance to actually look into stacks, because right now we're building completely on stacks. And I was just wondering if you see like a future where the work that you're doing on Sapo can actually enable more functionality on stacks.
Yeah, that's an awesome question. I actually get this quite a lot. I was literally right before this, I was talking to somebody at USD, which is one of the supporters of stacks. And they're like, is the stuff that you're working on kind of competitive with stacks? And the answer is, it's not really. I think that there's a synergy between it. The way that I think of it is that if you think of Bitcoin as modeling the real world, like things that are happening in Bitcoin transactions are kind of like the low level physics of the universe. And then different opcodes or primitives in Bitcoin are like these fundamental particles, things that you can do. And then in like circuitry, like you take these fundamental particles and atoms and you stitch them together in interesting ways to make hardware devices. And that's sort of where the smart contracts that I'm building with Sapio are, is you're taking different device physics and you're putting it together to make interesting and compelling circuits. And then those circuits, once you build them, you're going to need some firmware to program them or drive them. That firmware would be, okay, well, if we see some condition, when do we take a various action? When should we play a transaction happening at the Bitcoin level in the sort of more primitive sense? And then on top of firmware, you would then have some sort of operating system. And that operating system would be a much higher order behavior that you're layering on top of some underlying circuit. So I see stacks as being sort of like an operating system for a device that you would build inside of Bitcoin. So you can think of the devices that exist right now for stacks as being things like, how are you pegging Bitcoin in and out of the stacks ecosystem, and how, what sort of custodial contracts are managing the assets in Bitcoin that are held by the stacks chain. And that's where I see there being a really strong synergy. Is there are problems that exist for really anybody operating a side chain or maybe a higher layer chain, depending on how you want to view things. Such as how do you pay out if like 1 million people request a payout all at once? How do you actually manage paying them out on time? And there is the ability to manage those payouts at the operating system layer. You could say, well, we're just going to keep track of how many we can do at any given time on Bitcoin, and we're going to pay out on some schedule. And there's also the ability to add specific pieces of hardware that are going to make that experience much more elegant for a stacks user. So one thing that you can do with Sapio and Check Template Verify, for example, is you can commit to a dynamic priority queue of people who are requesting payouts. So Stacks as a chain can clear all of its contemporaneous payout obligations and send a payment that confirms fully with a constant amount of space to all 1 million people who just requested a payout. Those payments can be put into, for example, like Lightning channels so that are immediately usable, so that you can, you don't have to wait for them to clear on chain fully, but they're fully confirmed. So that piece of hardware would really help Stacks, improve the simplicity of the operating system layer, where they're saying, okay, well, how do we have to manage these payouts? I remember, I don't know the specific details. I need to do a little bit of digging, but I remember there was like an issue you guys had a little while ago around hitting some of the caps of like how many transactions you could get through on Bitcoin at any given time. So that's sort of the relationship that I see, is that like, it's not going to compete necessarily across all applications. There are definitely things that you can do at the operating system level that you're not going to want to do at the hardware level. But there are certain things that would really make it a lot smoother to be able to do on-chain in Bitcoin, and that would improve the UX for people who are using Stacks, but also for other applications that people want to build on top of Bitcoin as well. So it's a little bit long-winded, but I think the metaphor is kind of cool to understand.
And I'm actually kind of bummed I got to hop because I'd love to listen to Jeremy talk even further, but appreciate you guys having me on. Cheers, y'all.
Thank you, Dan.
Later, Dan.
Yeah, Jeremy, that was awesome, and I think I feel like there's a little bit more than that as well, because I think the mental model people should have is like half or most of the consensus for Stacks actually literally runs on the Bitcoin side. So any additional kind of like capabilities that you get on programming Bitcoin is actually directly useful in Stacks consensus. And then obviously the big part here is we want to do cross-chain stuff. So we were talking about these swaps recently, like where you could just do a Bitcoin transaction and you can swap it out to an asset on the Stack side. But it could be an NFT, could be a derivative or some sort of asset. But imagine if your programming capability on the Bitcoin side improves. Let's say you can do like these multi-step type of programs that are enabled by Sapio, then this cross-chain stuff also becomes more interesting, right? Because now your toolbox has become more powerful on the Bitcoin side. So it directly helps the stuff that developers are trying to do. So I think that's why I see a lot of synergy here, and the bandwidth limitation very quickly that you mentioned. Like we wanted to be respectful of the bandwidth on the Bitcoin side. Like we've actually been in this situation where Stacks 1.0 at one point was the largest consumer of off-return transactions on the entire Bitcoin network, right? And we had like core developers yell at us that this is spam, and it actually helped inform the 2.0 design, where now the bulk of the scalability happens on the stack side, and there's also only a bigger number of miners transactions that happen on the Bitcoin side, right? So it just depends on the number of miners on the Bitcoin side. But the 4,000 limit that we imposed for reward addresses was effectively like we don't want to consume more than a certain number of Bitcoin transactions per block, right? But if again we had these more advanced tool sets, or maybe you could plug in a Lightning channel or something, then you're not limited by Bitcoin's bandwidth, because you have a more sophisticated way of making payouts on the Bitcoin side.
Cool. We had a few more questions, but I know we're over time right now. How's your schedule, Muneeb? I think you have to jump, right?
I can hang out for a bit if you don't have questions.
Okay. HDP, when you're ready, go ahead with your question.
Hello?
Yep, go ahead with your question.
Hey, greetings. I just have a quick question here. I'm kind of new to Stacks, learning about it, but forgive this very degenerate question. Is there anybody looking at or working on randomness for your smart contracts? I'm just curious from like a DeFi perspective, I guess you could say, if on-chain Stacks side randomness has kind of been thought about, or is there anybody looking into that?
Yeah, so interestingly, this was something we had to work on the Bitcoin side to implement the consensus mechanism, because we had to implement a VRF. So VRF is a verifiable random function on the Bitcoin side, and that is actually a very useful primitive for other developers as well, purely on Bitcoin. Right? We use it specifically in our consensus, but a VRF is a general purpose type of function that can be used for other things as well. So for Stacks contracts, like because they have full visibility on the Bitcoin side, they can just use the VRF that is available to them from Bitcoin.
Oh, nice. So it's already built. Cool. Thank you.
Any other questions? All right, I think we're good here.
All right, awesome. Thanks everyone.
Thank you.
Thanks, Jeremy.
Yeah, thanks for having me up.
Take care, Dan.
Like we're having a little audio issue, but thanks everyone. We're gonna be back again next week, next Thursday, August 5th for another session of Crypto Internet. Thanks a lot.